Welcome to the program. Marty Shenkman, joined by my friends and colleagues, Jonathan Blattmachr and Robert S. or Bob Keebler. We're going to talk about what we keep talking about, but different. OBBBA, it's changed so much. And as the weeks have gone by, it's not that many since enactment of the One Big Beautiful Bill Act. We're thinking of new thoughts and new ideas and deepening some of the discussions about planning. So this program, we're going to dig deeper into the use and application of non-grantor trusts. Bob and I recently did a program just on that. We're going to talk in more depth on that. I don't mean to surprise anyone. Jonathan has a few opinions about some of what planning might be after OBBBA. Jonathan, you'll share opinions with us. You won't be shy.
I'll try not to be, Marty.
Okay. And we've talked with other colleagues about different things and wanted to bring up some of those issues as well. So we're going to talk about basis planning. We're going to talk about non-grantor trust planning. We're going to talk about a different sort of analysis of what type of trust planning and what benefits can be had from it. And so let's begin. The materials should be on the web portal. We don't give CLE or CP, but you should get a certificate if you can self-report. Two of our sponsors are not here because we did this so quickly, but Interactive Legal is a legal drafting software. I use it myself in my practice. Lots of the creative tools that Jonathan has developed in terms of special or flexible beneficiaries, which make a world of sense, and maybe he'll talk a little about it at some point during this program, are all available through Interactive. And I'll make a couple of comments as we go as to why, if you have not transitioned to document generation software, you really need to. I think the variability in planning really requires that you have document generation software. And there's the contact information for ILS. Jonathan, do you want to add anything about ILS?
No, we think it will really aid your practice. You can really, it's just going to reduce your time working on projects. You can do more for your clients. I've been working on this for 30 years, and I think it's the cat's meow.
Listen, post-OBBBA, planning for different clients will vary considerably. For many clients, it still makes sense to have grantor trust planning, whether for asset protection, estate tax, because nothing's permanent, we'll talk about that. But for other clients, it's going to make sense to have non-grantor trusts. To be able to offer a non-grantor slant to a client and a hybrid DAP to the spouse, you need to be very flexible in your drafting. I think it's long past due that we all adopt document generation software. Peak Trust is our other sponsor, and I have had my accounts with Peak Trust since 1998, my own personal account, and have used them for countless clients over the years. I find them responsive and intelligent. They don't always agree with me, though, Jonathan. I'll have to talk to them about that. Sometimes
Well,
they actually.
then they must be wrong, Marty.
But creating trusts in trust-friendly jurisdictions and DAP jurisdictions just makes a world of sense. And a lot of the planning that we're going to talk about will make sense if you are not practicing in a jurisdiction that permits self-settled trust to be in a jurisdiction that does. And Peak is in both Nevada and Alaska, which are two of the many leading DAP jurisdictions. Jonathan, you want to say anything else on behalf of Peak?
Well, I mean, Marty, like you, I have many trusts at Peak, and I've found them very responsive to my needs. In fact, I made a call to them at what was, I don't know, almost 8 o'clock New York time, asking that they send me certain information about the account. I had it in 5 minutes. Really very responsive people.
So let's dig into this. So we're going to start with a comment that I don't even think we should be talking about, but I've just heard it come up too many times, so I'm going to talk about it. And Jonathan, so forgive me for even saying it, but I've heard some colleagues, and maybe they practice in a different way than others of us, but You know, golly, now that we have a $15 million permanent exemption, I can just do simple wills for clients. Comment.
Well, well, of course, the word permanent is not really accurate because the law will change. I mean, you can bet your bottom dollar that when you get a new Congress and a new administration, which could be in, 3 years, or it could be in 13 years, or it could be in 23 years, but the pendulum swings, and you will find that all of a sudden things that you thought were fixed and permanent are no longer that way. In fact, Bill Clinton's administration, remember he was the last one in which we had a balanced budget, actually proposed that almost all the estate planning you did, even if it was irrevocable at a trust, nobody had powers to change, would come back into your estate. Now that was never tested, it was never enacted, but politicians want your money and they will do almost anything to get at it. So don't think things are permanent. And you have to have flexibility because the Congress and the Treasury believe that they have flexibility in how they will tax us.
Bob, have you ever had a client that's gotten divorced or sued?
Well, of course, Marty. And so I think this permanent issue, the pendulum will swing politically. We probably will not have a $15 million exemption forever. And even if you didn't have the estate tax worry, if I died, I would want my property to go into trust for my wife so that in case she gets sued. I mean, those are realistic things that you have to worry about. And I'm not sure that much changed as far as the structure of the bypass, the Q-tip. And also, we have to keep in mind, we have 12 states plus the District of Columbia that have their own estate tax. And Washington State just went to like a 35% top marginal rate on the estate tax side. I mean, absolutely incredible. And so I think a good part of the lawyers and CPAs doing this work are working in jurisdictions where you already have a state estate tax they have to contend with.
I think the proposal is preposterous that you should draft a simple I love you outright will or revocable trust for anybody. First of all, probate is still an issue. It's becoming more of an issue. So most plans probably should have a revocable trust. The delays and time lags to get assets through probate, it used to be talked about as an issue for probate, which years ago didn't worry me, but it's the delays have gotten much worse in a lot of jurisdictions. So using a revocable trust makes a world of sense. Should that trust pay outright? Never, because regardless of what happens with the tax law, we still have, give or take a 50% divorce rate. It's 75% for second and later marriages. And we have an incredibly litigious society. At minimum, people should be including, I think practitioners should be including in most, if not all documents, at least an ability to disclaim into a credit shelter or Q-tip type trust, so you have some flexibility. Jonathan, with ILS, with any document generation software, if I'm doing a revocable trust, instead of an outright bequest, I want to put in a disclaimer so it can disclaim into a credit shelter trust. How much additional drafting time does that take with ILS?
Not a minute, Marty. You can have it set it up. In fact, you can set up, what you want your defaults or your alternative provisions to be. Let me mention one thing, Marty. Years ago, of course, I admit I am the most pro-trust lawyer in America, if not the entire world. And I used to lecture, and I would say to the members of the audience, how many of you have done a will or a trust in the past year where you had property going outright at various ages to children or grandchildren? And probably 90% of the hands would go up. After I got done explaining the dangers of that, I would ask again, how many are you going to do it are going to do that in the future? Not one hand went up. Using a trust is the most wonderful thing you can do for your family, for creditor protection, from preventing the beneficiaries from foolish dissipation of the wealth they've inherited. I know of no one who says, well, I've made this money, I've worked very hard, I've saved, I've been diligent, but it's okay for me to have some creditor come in of my wife, for the second husband of my wife, for the second a spouse of my son to come in and take it all away. You just don't want that to happen. The only thing you can do, and it's tremendously strong throughout the United States, is to put it into an irrevocable trust.
And as Jonathan said, he usually exaggerates, but he really didn't here. It doesn't take any extra time. With document generation software, having a more robust plan literally doesn't take any more time. It's, to me, a mistake not to do it, and I encourage you all to continue to do it. And I think where that message is going to be most important is probably not for our audience today, but for the practitioners that are doing simpler work, and they should be including it routinely. It just makes too much sense. So let's dispense with that obvious topic, but I think it was important to say. Let's change gears and talk about a topic, and I'll give some credit to Alan Gassman, who it kind of raised the issue, but let's just take a couple minutes and talk about existing insurance trusts. And I know you have some strong views on this, Jonathan, but let me just make a couple of statements. The reality is that very few trustees of insurance trusts realize the liability that they have. And countless seminars, conferences, lectures have stated that it's really critically important that the insurance be periodically reviewed and evaluated by an insurance consultant. And I think the numbers are kind of astonishing, and I may not get it right, but it's something like 50% of insurance policies are projected to lapse before the life expectancy of the insured. In other words, policies are not being monitored. They need to be. Now, given that we have, and I acknowledge everything Jonathan said and Bob said, and I agree that permanent exemption is not permanent. It's only permanent until it's changed. But if you are a trustee of an insurance trust that has a couple $1 million survivorship policy that was bought years ago when the exemption was $2 or $3 million to cover an estate tax, I think it really behooves you not only to have the insurance review to make sure that the policy is performing, the carrier is still stable, et cetera, but the fundamental purpose for which that insurance was purchased may no longer make sense. The exemption may be a huge multiple of what it was when the policy was purchased. Now the exemption's permanent, even though it may change, and you should think about that. I think you really need to evaluate and communicate with those involved, especially the beneficiaries, I would think, as to, do we continue this policy? If you keep pumping money for trust into a policy that doesn't serve the sole purpose for which it was purchased, I think you could face some exposure. And I think you could do those involved a good deed by evaluating options. You may choose to do nothing and say, hey, the policy is performing well, it's still a decent investment, and we don't think permanent means permanent. But I think protecting yourself by getting everyone on board with that is really important. Jonathan, I know you have a few comments.
Well, I have many comments, Marty. First of all, I think that, I once got a letter from the president of one of America's largest insurance companies thanking me for being such a pro-life insurance person, and I really am. But you've got to remember a couple of things. Let's say you have an insurance salesperson come in and says, well, Bob, your estate is $20 million. So you need at least $5 million of coverage, because of that 20, you're going to get a $15 million exemption. Of course, as Marty just said, that may go way down in the future, but he says you need a $5 million policy. Well, let's assume that everything is steady state, and it won't be. But what does it mean if Bob lives for 10 years, even if he only has a modest growth in his wealth, either for inflation or because he's a very good and astute investor? It means that in 10 years, his estate isn't going to be 20 million, it's going to be 40 million. And that means instead of 5 million of insurance, assuming again, which is a false assumption that the exemption will remain at 15 million, it means he no longer needs 5 million of insurance. He needs 25 million of insurance to cover the taxes and the loss of wealth. So as a consequence, you've got to really be aware that when you get a policy of insurance to cover something, that something is probably going to grow and you're going to need more. One of the problems is, as the insured ages, the cost of the insurance shoots through the roof. And one of the things that I've written about with one of my co-developers in our company called Pioneer Wealth Partners is to really have great flexibility and have the ability to withdraw the cash. In fact, if you're buying a policy and you say, well, I want the maximum I can get for this, and that's standard. I mean, when you buy something, you want the most for what you pay. You don't want that for insurance. You want something where you're not getting the biggest death benefit, but over time, you're going to have the cash value grow, because eventually, if you live long enough, and of course, we will hope we will, you're going to want to get more out of the policy and not just rely on that death benefit, because the value of that death benefit covering your estate and the replacement of wealth is going to go down over time. Now, I'm a very pro advocate for life insurance, but a few years ago, I ran some numbers and I decided that if I lived for 10 years, I was much better off dropping the policy, taking out the cash value, making alternative investments in the stock market, and in 10 years, I would be about twice as far along for myself and for my family, and that's what I did. So if you've got a policy and you say, oh, well, and this is a second to die, let me say something about second to die policies. I think I was the first one in the country to talk about second to die policies. I did it for the $1 Million Roundtable back in 1981. When the marital deduction became unlimited and people in the industry were very down on it. So I said, well, how about if you have a policy that only pays off when the second spouse dies? And everybody thought that was just fantastic. Well, again, that really isn't the best thing you can do. And the reason is that, again, not only is it going to mean that you need more insurance because the value of the survivor's estate will grow, but the cost of the insurance is not going to be based upon two people dying, but once the first spouse dies, on one life. And the cost of the insurance will just shoot through the roof. And in fact, most so-called second die policies have the premiums increase drastically when the first spouse dies, because the insurance company now only has to worry about one life ending rather than two lives ending. So I wrote an article about rethinking survivorship or second to die insurance, and it's really worthwhile thinking about. And if you want it, you can write to Marty and he'll be happy to send you a copy of that article.
The bottom line, everyone, is it's a mistake if you're a trustee or a counsel or an advisor representing a trustee not to review the coverage and the planning of any insurance trust post-OBBBA. You may very reasonably say, you know what, if the policy is performing and the carrier is still solid, it's a reputable carrier with good ratings, we're not changing anything, we're staying the course despite the higher permanent, so-called permanent exemption. But I think it's very protective to do that and to offer options. Bob, I'm going to just go through a few options and see if you have any comments. So what was the primary purpose or various purposes for the policy being purchased? Maybe you can repurpose the policy and use it in a different way. A policy that may have been purchased thinking you're going to pay an estate tax may be a good income tax deferral source. It may just be a way to diversify the investments because almost all the other wealth is in a particular family business. If the policy is performing, evaluate whether you should keep it just in case the so-called permanent exemption gets reduced in the future, as Jonathan talked about. Can you convert the existing policy into a different policy? Maybe you convert it into a paid-up policy and just leave well enough alone. The policy might be able to be sold and there could be a value. Can you swap or sell or buy the policy back to the insured and convert it to a policy with long-term care features? In many cases, we've taken these old ILITs and decanted or merged them into slats or other more robust current trusts, often having to make a late allocation of GST because they weren't GST exempt. It simplifies planning because now you have one trust instead of two. It avoids any funding because there's enough assets in the slat or other larger irrevocable trust, and makes planning simpler. Bob, any comments on insurance before we go on?
Absolutely, Marty. I think one thing that we haven't talked about enough, and OBBBA changes it a little bit. Many of your clients will have these large IRAs, okay? And you have three choices. Let the IRA run its course and leave it as a testamentary disposition in the form of a traditional IRA, do a Roth conversion, or along the way, take money out each year and buy insurance, okay? And if you're in one of those 12 states I spoke about before, where there's a state estate tax, or if you're in Vermont, Massachusetts, Connecticut, Maryland, or Rhode Island, and a handful of other states, you're way better off to take money out of the policy along the way, pay your taxes, and then jettison that money into a life insurance trust that's outside of your state. So many of my lawyer friends will tell me a good third of the people they see, the majority, the largest asset they have is their IRA. And we can do some real planning there. Now,
But Bob, why do you limit that to those states you mentioned?
great question, Jonathan. This is where we get to the deep end of the pool. When I die, I get it, and I pay estate tax on my IRA. I get a 691C deduction. That's an income tax deduction for the estate tax paid. So if I died in Wisconsin, 40 cents goes to the federal government. When I pay my federal income tax, I take $1 million IRA minus 40 cents or 40% federal estate tax. I only pay income tax on $600,000 for federal purposes. Okay. Now, if you're in Massachusetts and you die, you pay your federal estate tax, but you have to pay your Massachusetts income tax on 100%. They call it conforming. State law doesn't conform to federal law, Jonathan, and you do not receive a 691C deduction for state income tax purposes. We've been running numbers on this, and literally the wealth transfer can go up by over 35, 40% in those states. And so if you're in those states, you can't just accept putting the blinders on and letting the IRA go from your client to their spouse to their children. You have to either do a Roth conversion along the way, or you have to take money out to buy insurance. Now, that's only when you're going to have a state estate tax or a federal estate tax. If you're below those limits, not a problem. But if you're above those limits, I think the lawyer has to change their approach a little bit. I don't think the lawyer has to do the math and figure out with precision what to do, but they have to refer that to other advisors that can really look at that and determine the math of the strategies. If I die at 80, 85, 90, 95, what is the best result for my family? And we can flow chart and line graph all that out, Jonathan.
Well, Bob, you know, what you say is extremely important, because if you have large amounts of income in respect of a decedent, which you're going to have with a qualified plan or a traditional IRA, not a Roth IRA, you're going to face the possibility of double taxation. And you really need to think about what you're going to do. Keep in mind, Bob, and of course you tried to change this. Right now, today, it appears that you cannot get rid of an IRA or a qualified plan. You can't even get rid of a Roth IRA before you die without having some consequences of that. And that makes it the most dangerous asset in your plan. You can't put it into a limited partnership. You can't try to discount its value. So you're stuck with this asset, which is pregnant with income in respect of a decedent, and the effective rate of taxation. Like if, let's say, the decedent lived in the state of Washington, which, Bob, as you indicated, now has an estate tax rate of 30% plus, plus you have, say, the inheritor, say the children live in New York or Massachusetts or Oregon or California, where you have high income tax, the effective rate of taxation on that IRA or qualified plan can approach 90%. Wow, what an erosion of your wealth. So Bob is absolutely correct. You need to think about taking the money out, paying some tax at some point, but overall you'll have more, because you really can't do much effective planning with an IRA or a qualified plan for purposes of avoiding estate tax or the double tax that will be due when the owner of the plan or IRA dies.
So let's change gears completely and let's talk about basis planning. Now, for very wealthy people, they still have estate tax issues. Doesn't mean basis is not critically important. But with a $15 million exemption, the estimates are that only something like 0.2 or 0.25%, a quarter of a percent or less of families will pay an estate tax. So Bob, why don't you give us some background on how post-OBBBA at least as long as we have these high exemptions, why the environment changes for basis planning, and we'll go through lots of different things that we can talk about with respect to basis planning, because that's a major new issue for lots of people and very important for practitioners. This is important planning for the whole range of clients, wherever they are on the wealth spectrum, even those with much more modest wealth.
So I think where we are, if let's just stipulate that we're not going to have any estate tax, Marty, on my estate when I die. So then the question is, do I leave my property to my wife, hoping for a second step up in basis when my wife dies? Reasonable question. Now, if you're in a community property state, of course, there's a double step up at the first death, but then you still would want another step up when your spouse dies, a second step up. So you're juxtaposing the step up under 1014 versus asset protection concerns, divorce concerns, etc. Couple of things we can do. I could leave everything to my wife, that would be one thing, or I can leave everything in a bypass trust for my wife. Or a Q-tip, but let's go with the bypass trust. I go with the bypass trust, and Marty, when you draft that, you grant my wife a contingent general power appointment. And if she has extra exemption left, she'll be able to use that exemption to appoint my trust. And under section 2041 of the code, if she has a general power of appointment over property, it's included in her estate and she receives a step up in basis. Now, the alternative to that is I could leave everything in a Q-tip. When I die, when we do the estate tax return, we would make a Q-tip election, and then that's also included in my wife's estate. So what I would challenge everyone to do is to look at, how do I get a step up at basis at the second death without incurring an extra penny of tax, an extra penny of state or federal estate tax? Jonathan, thoughts?
Well, of course, Bob, as you know, I'm a real fan of the Delaware tax trap. Jeff Pinnell and I wrote an article about this in the April 1988, geez, that's a long time ago, issue of the Journal of Taxation. There is a provision that went into the law in the 1950s, which basically says if you have a limited power of appointment, which will not cause the property to be in your estate, we will treat it as a general power of appointment, putting it in your estate. And of course, you would then get a tax-free, you'd get a step up in basis. If the person who holds that limited power exercises it to begin a new rule against perpetuities under local law. And there are many states where you can do that, but Arizona may be the most wonderful one, because there, if your trust is in Arizona, you can give a beneficiary a limited power of appointment, and the beneficiary can exercise it in a manner to cause it to be in his or her estate, triggering section 2041A3, which will cause it to be in their estate. But still, it will be completely asset protected, because it's not a general power of appointment. Or you could do it actually in Alaska, because under Alaska law, even if you have a general power of appointment, it is not subject to the claims of your creditors, except to the extent that you actually exercise it in your own favor. But as Bob points out, you want to start with things in trust. All of the flexibility we have, all of the opportunity for tax reduction and asset protection start with one thing, and that's a trust. You have to start with things in trust. I just can't imagine any reason why you would have anything pass outright. I used to prepare wills and revocable trusts where I would have, say, the tangible personal property and certain other things go outright to the spouse. I don't do that anymore. What I do is I have it all held in trust, understanding that if we need to get it outright, we can go ahead and have the trustee exercise the power to give it to the spouse. But that way, it's completely locked in the most protective thing in the United States, and that's a trust which someone else has created for your benefit.
Let me belabor the idea for a second by asking you both some questions, because it's an intriguing idea that Bob mentioned that I think is different than how the vast majority of estate plans are structured. Most people, if they want a second step up on death, and if they agree with and understand your comments about the importance of trust, Jonathan, they're going to leave assets in a Q-tip trust for the surviving spouse. But a problem with the Q-tip trust is all the income must go at least annually to the surviving spouse. And many of our clients are in second, third, fourth marriages. And in those cases, we really would prefer, the client would prefer, to be able to sprinkle income, and I would hope they would name an independent trustee, between their current spouse and descendants from prior marriage or marriages. But if we use the credit shelter approach, the typical downside in traditional credit shelter family trust bypass trust planning is there's no basis step up death. And if I give this letter of appointment that can be converted to a general, then we can get a step up on the death of the surviving spouse while nonetheless benefiting children from marriages. But it sounds like we need to be a little cautious in how I gave the spouse a general power of appointment over that trust, which means just, let's say, appointing to her creditors of her estate. Under some state laws, maybe under many state laws, that now could expose those assets to the reach of her creditors. So what you're suggesting, Jonathan, is that this credit shelter trust for a typical blended family, so I can get the second basis step up, could be in Arizona. Are there other states that would permit this power to be exercised to trigger the Delaware tax trap without it being a general power to use the
Well,
limited
yes,
power?
there are many states where you can do that, but the problem is it may become subject to claims of creditors because in all states, as far as I'm aware, other than Alaska, if you hold a general power of appointment, even if you don't exercise it, it's subject to the claims of your creditors. So you say, well, this is great. I'm going to put it in trust for my wife, and I'm going to give my wife a general power of appointment. Well, that means it may be subject to the claims of her creditors, which means if she's remarried or he's remarried, you may have a claim by the surviving spouse or the children of the other spouse or by other creditors. But if you do it in Alaska, unless you exercise it in favor of the spouse, only if she or he exercises it in their own favor, you will not have creditors being able to attach it. And in Arizona, you can live with a limited power, which won't make it subject to claims of creditors. These are things that are difficult for lay people to understand, but are critically important. But it gives you an opportunity to serve your clients so well, and they don't have to worry about second marriages and stuff. Because as Marty said, the numbers even on first marriages is about 50%. But for second marriages and third marriages, the rate of divorce is even higher.
75.
75, Marty says. But no matter what you do, you want to prevent claims to be made against that property. Having it in trust, not granting a general power, at least in a state like New York or California or Wisconsin, where it can be subject to the claims of the creditors of the power holder. You don't want that. You may remember there were things called palimony, where Bob, took up with a younger woman, and I know he'd like to do that. And even though he doesn't get married, he dies, and the girlfriend says, hey, we were in the equivalent of a marriage. I'm entitled to certain things. He and I had a partnership going, which gave me rights to his property, including property that's in trust for him. So you want to avoid that at all costs. And, you really need to talk to your estate planning attorney about that and go to a state where you can really protect it.
Jonathan, let me belabor this another second because I want to make this actionable for practitioners. So client comes to me, typical planning, which is still good planning and lots of folks do it, and I think more should be doing it, is we're going to leave everything in a Q-tip trust because it's protective. We can allocate GST with a reverse Q-tip election in case that becomes necessary. Why not? And it provides some protection for the surviving spouse, and on second death, we get a basis step up. We can often do build in a disclaimer provision so they could disclaim to a credit shelter trust. But the problem with the credit shelter trust, if there's a disclaimer executed, is it doesn't get the basis step up on the second death. The other problem is with this approach, in blended families, I'm not really helping the children, and I can't even get money to them if it's all in a Q-tip. So if I'm in, let's say, New Jersey, and I want to draft a credit shelter trust, but I want to get a basis step up, If I draft a revocable trust that provides on the death of my spouse that up to the exemption amount, everything goes into a credit shelter trust for my current spouse and children from prior marriages, I've now accomplished all my personal goals. I'll name an independent trustee. Can I say Alaska law shall apply? And then, as Bob described earlier, give a GPOA, general power of appointment, for my current spouse to appoint to creditors of her estate. Because I've named Alaska laws applying, does that suffice to get the result that creditors in New Jersey cannot get at it? Do I
Well,
have to
Marty,
have the trust situs in Alaska with an Alaska trustee?
Marty, there's a very famous case out of the bankruptcy law called In Re Remington. And in Remington, it was involved Pennsylvania and New Jersey, but because the trust was governed, I believe it was the law of the state of Pennsylvania, it was not subject to the claims of the power holders' creditors. So you've got to do a little bit of shopping that way. But if you want it to be governed by Alaska law, you do two things. One, you name at least an administrative trustee in the state of Alaska and declare that the trust will be governed by the laws of the state of Alaska. And that should protect it entirely. And in fact, as I said, Marty, even if you give one of the beneficiaries a general power of appointment, it will not be subject to the claims of his or her creditors, as long as it's not exercised in favor of his or her estate. But if it's not exercised at all, you should be golden on that point. By the way, very often you're going to want to do asset protection trusts, and you're going to want to locate it in a state which has strong asset protection law. And there are many: South Dakota, Wyoming, Alaska, and all have pluses and minuses. But you need to make sure that you do that in the good place. But keep in mind that if you want to grant someone a general power of appointment to ensure there's a step up in basis at death, you can do that, but you have to ensure that you don't make it subject to the creditors of the power holder.
So, Jonathan, you're to clarify so that people know how to act on this. I can't just create a credit shelter trust on the death of the first spouse that benefits surviving spouse and kids from prior marriages, put it in say in the trust document that's, let's say, for the same hypothetical in New Jersey, say Alaska law applies, give a GPOA to my current wife in the credit shelter and get a step up. In order for that to work, you're saying I have to have more nexus to Alaska by naming a trust company in Alaska, trustee in Alaska.
Well, Marty, there may be
Isn't the recitation? I thought the law was that if you name a state law as governing, it will govern.
I don't think that is entirely settled, Marty. I mean, certainly people who sign contracts every day, let's say you have a person from Ohio and a person from Maine enter into contract, and they say this document will be governed by the laws of the state of, say, Delaware, which is a common thing to do. Well, why can't you do that for a trust? Well, remember, the beneficiaries and the creditors are not going to be parties to that trust agreement. And it appears that if you have a sufficient connection or nexus, as you called it, Marty, then you can choose a state. But you just can't say, we've got two people in New Jersey and they say, well, we're going to have Alaska law apply. You need some strong nexus, for example, having a trustee there or having a lot of the property located there. But you really need to think that through.
So we're going to talk about a lot of other aspects of basis planning post-OBBBA. Upstream planning, downstream planning, dealing with assets in existing trusts, and so on. So let's talk about some of the basics of basis planning. Jonathan, you want to go through some of the fundamental concepts, and then we'll talk about some more details. Hopefully, the discussion has gotten everyone excited about basis. Not that anyone should need to be excited about basis. Why we're excited about this, but give us the background on basis, and in particular 2023-2. I know you have some thoughts on.
Yes, I do. I had a brilliant colleague at Milbank who now works at Greenberg Traurig with Diana Zadel, named Madeline Revelin. Madeline was exceptionally gifted. And she and I wrote an article about 10 years ago entitled Searching for Basis in Estate Planning, More Tax for Heirs. And we started, and even though the exemption, Marty, was much lower at that time, we said, hey, you shouldn't be focusing on avoiding estate tax so much. You need to be focused on getting a stepped up basis. And we talked about that. And one of the things, of course, is to give people either a Delaware tax trap power or a general power, or otherwise have it put in their estate. So under section 1014, you could go ahead and get that basis step up. Now, along the way, I came up with a notion of doing an installment sale to a grantor trust. The IRS had conceded in Revenue Ruling 84-13 that you could basically have transactions with a grantor trust and they would be ignored for federal tax purposes. So, I could, have assets that would be not in my estate for creditor purposes, but in my estate for stepped up basis purposes. And that made a lot of sense. And Madeline and I went through how that was done, including triggering the Delaware tax trap. I was kind of criticized for that, people saying that doesn't work. But Mitchell Gans and Hugh Jacobson and I wrote an article pointing out that it does work, that people were saying that if I make an installment sale to a grantor trust and that note is outstanding when I die, under Revenue Ruling 77-402, and you might want to write that down, you would have a state tax, income tax, when the grantor of the trust died, because it would no longer be his, it would be transferred over to someone else. And a very famous lawyer in the United States wrote an article criticizing me for the concept of an installment sale to a grantor trust. And then a couple of more lawyers in Chicago said the same thing. Blattmachr's idea just doesn't work. Well, Mitchell Gans and Hugh Jacobson and I wrote an article which appeared in the September 2002 issue of the Journal of Taxation, pointing out 7 reasons, including 3 Supreme Court cases, why you didn't have to worry about recognizing income when the grantor of that trust died. In fact, the courts say that the non-recognition of death is one of the strongest principles in American income tax law. But in any event, we wrote that. In fact, one of them, one of the authors of the 2 that were in Chicago actually called me and said, Jonathan, I apologize. You were right, we were wrong. There is no gain recognition on death. But Mitchell took it a step further. He said, but what about basis? What is basis going to be when you have assets in a grantor trust, which the IRS has told us in 84-13 that there would be no gain recognition? Would you get a stepped up basis? And we took the position in that article, and Mitchell led the way on that, that yes, you would get a tax-free step up in basis, even though the asset would not be includable in the grantor's estate. Well, everybody knows that in order to get a tax-free step up in basis, it has to be includable in the estate. But we said, no, that's not true. And finally, people, again, at the beginning just said, this is crazy. Blattmachr, Gans, and Jacobson are out of their minds saying you could get a stepped up basis without having a state tax inclusion. But along the way, the IRS issued a private letter ruling in 2012 saying, yes, you can get a tax-free step up in basis on an asset in a grantor trust, even if it's not includable in the grantor's gross estate when she dies. And then people began to write the IRS and say, well, I want a private letter ruling as well for my clients who've got assets in what is a grantor trust, even though it's not in the estate. So when the client dies, there will be this income tax-free step up in basis. And so the IRS finally came out with Revenue Ruling 2023-2. And in there, they said, you can only get a stepped up basis if it's includable in the gross estate. Now, Mitchell and I, in September 2023, wrote an article in the Journal of Taxation again, pointing out some flaws in that revenue ruling and why you could get a tax-free step up in basis for assets in a grantor trust, even though those assets were not includable in the grantor's estate. Now, there's another way around this, and it's important for people to do it. And everybody listening to this has a client who has a trust out there. And you said, we've done a great job. We've gotten all these assets out of the grantor's estate. We're heroes, we're heroines. We did a fantastic job. We got all this wealth out of the estate. But what you miss, of course, is the tax-free step-up in basis. And Marty perhaps will tell us a story about a firm in New Jersey which has been sued because even though they did a fabulous job of getting the assets out of the gross estate, after the patriarch of the family died, the family members came in and sued the lawyers, and I think the accountants as well, because they didn't get the stepped-up basis. And Marty, maybe you can tell us what the end of that story is when I'm done. But the bottom line is, we took the position that you could get the stepped up basis without it. But here's what you're going to do, because a lot of people on this, 90%, 95, 98% are going to say, I don't buy it. I saw your arguments in your article with Mitchell in the September 2023 issue of the Journal of Taxation, but I just don't buy it, so I can't do it. But here's what you can do. What you do is you have the client, the grantor, buy the assets back from the trust. Now that is a non-recognition transaction. So you buy it back and you want to use borrowed cash or some other assets. Don't use a note. I won't get into the details. But now you own the assets back. Now they're going to have a very low basis and there will be a stepped up basis when they die. The assets which you've now transferred over to the trust to buy the assets back will not be in the estate. So you're not going to increase the estate tax at all, but now you're going to get a stepped up basis because the assets are back in the gross estate because they've been purchased. And that can happen the day before the client dies. So the client's on his or her deathbed. You either use other assets which have a high basis, or perhaps you borrow it from a bank or somewhere else. You use that asset to buy the assets back. Now the trust that's out of the estate has high basis assets, and the low basis assets, which are now owned by you because you purchased them back, will get a tax-free step up in basis at death. And that's something that you need to go to every one of your clients and say, I'm going to do you an enormous favor. We've gotten all these assets out of your estate, and now I can tell you how we can get a tax-free step up in basis at death. So Marty, that's one of the things that should be considered.
Let me jump to slide 18 and make a few comments, and Bob, I'll tee you up for some more basis planning in a second. One of the things that I know is going to happen, we all know is going to happen, clients are going to resort to self-help, and I'm sure they'll do an AI search before they do this on their own without calling any of their advisors, and they're just going to bust old trust. A client with a credit shelter trust is going to just yank assets out of it so they can get the basis step up. The problems with clients terminating trusts is, first of all, as I said in the top of slide 18, we've talked about it, the permanent exemption may be anything but permanent. We have no idea what's going to happen. And honestly, when I think back to all the decades of practice, and for the last X number of years, all the webinars I've done with Jonathan, every time there's a new law change proposed, it's a roller coaster. It changes all the time. It makes no sense to plan inflexibly as if we know what the law is. We only know what the law is today. So we always need to infuse flexibility. If people pull assets out of that typical bypass trust that doesn't have the mechanism that Bob talked about to get a basis step up, they're potentially ignoring lots of claims on it. Medicaid, lawsuits, incapacity, divorce. The incidents of elder abuse are epidemic. Romance scams where somebody feigns romantic relationship with the surviving spouse in order to scam them out of the money. If the money's pulled out of these trusts, it's exposed to all of this stuff and more, and that really needs to be considered. Bob, let's change gears and we'll get
Marty,
back to some. Yeah, sure.
I think I may have said Revenue Ruling 84-13. It's 85-13. And I know you and Bob were being great gentlemen by not pointing that out, that I had made that error. It's 85-13. It's something that you need to name your next pet. 85-13. It is the most important ruling that estate planners have ever gotten from the IRS.
Jonathan, I'm keeping track of all the citations of articles and references, and at the end of the program, we're going to test everybody on this program to make sure. And if they don't get at least a 75%, we're gonna come after them. Bob, just looking at the slide on slide 19, I'd like you to take a big picture view and discussion. Things have changed. We have lots of different types of trust that we can create, but the dynamic has changed for many clients, and this will lead into our discussion in non-grantor trust. But this is complicated, And I'm not sure a lot of people have focused on how different it can be. Can you explain some of this and why it may be different, and how practitioners can give a greater value add to their clients understanding this?
Sure, Marty. When
And
we're
you can
talking,
quote Steve Oceans if you want with his trifecta, whatever.
um, when we talk about a completed gift versus an incomplete gift, I gift property in trust for my grandchildren. I retain absolutely no rights. It doesn't come back to me at all. That is typically a nice, clean, completed gift. I will have to fill out a gift tax return and inform the government of that gift. So if that was a $1 million gift, that's what I would do. Now, if
And
it's
Bob, are you likely to be audited?
Jonathan, I have audits going on right now, and the government does a very nice professional job of this, but the incidence of audits have gone down. Okay. So I think, but I would, every time we do something, we expect to be audited. But the reality is, if I file 100 gift tax returns, 1 or 2 will be audited.
And Bob, if you make a cash gift, is that likely to be audited?
Absolutely not.
Why is that, Bob? Are you saying that the government is only in it for the money?
Well, there's no chance on cash, US currency, there's no chance of the IRS of adjusting the values. So the only thing they'd be interested in is whether I had made prior gifts that already burned up my exemption.
So if you make a cash gift, whether it's outright or in trust, the chances of an audit are exceptionally low, correct?
Absolutely. So when we have a completed gift, it's a bona fide gift. We've transferred that property away from our taxable estate. Incomplete gift is interesting because we can draft the trust in such a way that we do not have to file a gift tax return. And later when we die, the property in that trust comes back into our estate. So that gives us a step up in basis. Okay, now why would we do that? We might do that as a non-grantor trust, Marty, so that we can do some interesting things under OBBBA. Maybe we want to improve our SALT situation. We want to shift our charitable away from section 170 over to section 642C.
Bob, just so you know, we have detailed slides on all this we're going to come to after this introduction.
Wonderful. We might want more 199 cap A, just like you laid out in bullet point 1. Now, be careful with New York and California. They're on top of this. They have already said we can't do NINGs. A completed gift, though, does accomplish those goals in New York and California. And the IRS is no longer issuing private letter rulings on the incomplete gift strategy.
So when we're evaluating what type of planning we want to do for clients, we're going to go through in some detail the post-OBBBA income tax planning, because the income tax benefits of trust planning can be very different post-OBBBA than pre-OBBBA, and it can be a very powerful tool even for clients that have nowhere near an estate that level that's going to trigger an estate tax. So non-grantor trust planning can be important. Traditionally, I think it's fair to say that the significant majority of irrevocable trusts done for the last decade or longer have been grantor, because we could have the swap power to swap assets back into the estate. We can have a power to add a charitable beneficiary. We can have a power for the settlor to get a loan without adequate security. There's a lot of advantages.
And Marty, of course, the major advantage is that the grantor pays the income tax, which allows the assets in that trust to go tax-free. Tax-free compounding is usually the most powerful force in all of financial planning. And you get that with a grantor trust. Now, the IRS, at one time, I began to lecture about this back in the early 1980s. The IRS was very angry, and they issued a private letter ruling saying, oh no, if you have a grantor trust and the grantor is paying the income tax on the income which the trust is receiving, the grantor will be making a gift to the beneficiaries of that trust. I wrote a letter to the head guy at the IRS in this field and said, if a taxpayer took a position as ridiculous as the one you have, you'd either have her put in jail for tax fraud or you'd have her put into an insane asylum. A week later, they withdrew that private letter ruling, and 10 years later, in Revenue Ruling 2004-64, the IRS conceded that the grantor's payment of income tax, which is imputed to her under the grantor trust rules, even though she wasn't entitled to any of that income, would not be a gift. And Diana Zadel and I did a big study many years ago about using grantor trusts or not. We found the most powerful factor of all in planning was the use of a grantor trust because of the ability of the grantor to pay the income tax and allowing the assets in the trust to grow entirely income tax free.
And that still is probably true for the wealthiest top tier segment of clients. But for a significant vast majority of clients, for the vast majority of clients that aren't going to pay an estate tax, OBBBA has changed the dynamic. And we're going to talk about a different perspective as to why a non-grantor trust may make sense. But just to summarize the sort of overview Bob gave, we can make grantor or non-grantor trusts. We can make completed gift trusts or incomplete gift trusts. The comments that Jonathan made have been exactly what has fueled and governed much of estate planning, most of estate planning for decades. It is now different for a swath of clients, and that's what we're going to talk about. That's what we're going to talk about. And by the way, one of the things that I think is very important, and I mentioned earlier I was going to plug document generation a couple of times in the program. When you start to cobble together a plan, you may in fact want to do for one spouse a grantor trust for all the reasons Jonathan just said, and also because as a grantor trust, the ability to add a beneficiary, including the settlor in a hybrid DAPT or to allocate income as a SPAT, you may want as a grantor trust. Whereas for the other spouse, perhaps you're going to do a non-grantor trust, a non-grantor spousal lifetime access trust, a SLANT, and you need to be adept at customizing all the different trust techniques you're using. If you have a database of forms, I don't know how a firm, even a firm with a large number of attorneys, can keep documents with that degree of flexibility current for all the changes in the law. That's where I think document generation is a very powerful tool. Very important for some practitioners, many practitioners. When you get out of the upper stratosphere of wealth levels and you're planning for people 10 million and under, the cost of customizing a document could be very high and an impediment to clients being comfortable proceeding with the planning. Document generation software like ILS, and there's others, can facilitate and enable you to very cost effectively create all these different types of planning tools and customize them for the specific client circumstance. Bob, before we go on, you got to give Steve Ocean's credit. He always comes up with clever titles. Tell everyone what the trifecta is, because it's a cute title and maybe it has something to do with the Las Vegas influence, but just tell everybody.
Bob, you're muted. You're muted, Bob.
Here's the concept. I can create a non-grantor trust, and the original thought was I would create a non-grantor trust to reduce mine and my wife's income on our 1040 to move it to a 1041 so we could recapture our SALT deduction as our SALT went from 40 back to 10.
We're going to go through that in detail. You don't have to get deep now.
And then it became obvious that we could do other things. We could use a non-grantor trust to enhance our charitable deductions, a non-grantor trust to expand 199 Cap A, or a non-grantor trust to stack up our QSBS stock.
Is that the trifecta?
That's the trifecta.
See, I've talked about that, but I couldn't come up with a clever term like Steve did. So we got to give him credit for the term. It's cute. Right,
and if you get 4, that's when you have 3 of those advantages going. If you can get to the 4th advantage, then it becomes a super trifecta, Marty.
Okay. All right. So we need to evaluate basis planning, and we're going to look at the income tax and basis planning and the interrelationship of it. Now, downstream planning is something that doesn't get talked about. We'll talk about upstream planning. Everyone knows that is. You give a GPOA, a constrained or confine GPOA to a say an elderly parent or other benefactor, aunt, etc., to get a basis step up. Bob, do you want to explain downstream planning? It's the good old gifting we used to do, because it just has a different environment with this high permanent exemption for now.
Right. Let's jump beyond the kiddie tax. We have an adult who's 25 years old. She's out of college, and parents give her Apple stock they paid $1 for. She waits, say, 60 days, and then she sells it for $100, $200. That capital gain is going to be on her return, not on her parents' return. If there were dividends on that in the meantime, those dividends would be taxable to her, not to the parents. So let's say the parents are in a 37% rate and she's in a 12% rate on ordinary income, Marty. That's an arbitrage of 25 cents on the dollar.
It's pretty big.
It's pretty big. And I think with such a high exemption, people are going to want to do that more. Now, I can have my cake and eat it too. I can do a spousal non-grantor, spousal lifetime access trust for my wife and my children.
Bob, how do you make it a non-grantor trust?
We're going to come to that, Jonathan. We're going to come to that. We're going to come to that. We got slides on that. I know you're excited. We're going to come to that.
But if we do that, and it's a drafting method, it's very easy to do on ILS software. But the thing that comes down to is I could be making distributions every year to my daughter, picking up that 25% arbitrage. But my wife could still be in the background as a beneficiary of that trust. So I wouldn't give up that financial security for my wife, but yet we'd pick up, as long as things are good, that income shifting ability in the interim. So I think there's tremendous opportunity here.
Well, Bob, let me ask you a question. Suppose I don't have a wife, or I'm in a second marriage situation. Can I do it and be a beneficiary of that trust for myself?
Well, Jonathan, you've written a lot on this, and I think we can do something like that in Alaska or Nevada, Wyoming, one of the domestic asset protection trust states. The IRS issued a ruling, I think in 2009, that actually works. So, but we have to do it where my creditors cannot get access to that trust.
But the bottom line,
and again, if you're in an asset protection jurisdiction, by definition, your creditors can't get access to it, even though you are an eligible distributee from that trust. So again, if you don't have a spouse, or you do, but you don't want it for your spouse because you're in a subsequent marriage situation, you can create it for your kids and put yourself in there, as long as the distribution can be made to you only with the consent of an adverse party. That can be used to prevent it from being a grantor trust.
Yes. Let me just summarize and move on. One of the concept we're trying to bring up is, we talked about basis planning. Everyone's familiar with upstream planning. We'll talk about it a little more, time permitting. But there's not much talk about downstream planning, and that should be kept in mind. Exactly as Bob said, for the vast majority of taxpayers with a $15 million exemption, they can gift assets to a child or other heir. Those assets can be sold and a substantial income tax savings realized at the child or other heir's lower tax bracket. And the child could then, because they don't care about their exemption because it's so high, gift the assets into a trust that benefits lots of different people. You just have to be mindful of the step transaction doctrine. But the point is, shifting wealth before sale can provide a very substantial income tax savings, and just keep that in mind. Jonathan, yeah.
One more small point. If you could go back to that prior slide, please.
Sure.
It's a small point, but everybody should have this in the back of their mind. We have to deal with this kiddie tax, but I just taught an AI CPA class, and one of the CPAs on there pointed out that you can even transfer up to $2,800 to grandchildren and have it not be subject to kiddie tax. So Marty, she just passed away, but I represented a lady who had like 40 grandchildren and great-grandchildren. And that means we could move that much money off her return and it wouldn't even be taxed.
And that's one of the general income tax benefits of a non-grantor trust. So if you have 10 grandkids and you can move 2,400, I don't know, it's approximately that number, off to without a kiddie tax issue, you can give 10 times 2,400 every year, year after year, where there's no tax. So it's just one of the other many benefits of non-grantor trust. Jonathan, one of the things that people can look at for basis planning, if estate tax is not the driver for them, is setting up a community property trust that a limited number of states have, so they can get a full basis step up on the first death. Why don't, and don't worry about the slides, just give us like a 5-minute overview of that planning and why that's relevant.
Well, beginning in 1948, the Internal Revenue Code was changed to say that the surviving spouse's half of community property, the part that the survivor didn't own, would get a tax-free step-up in basis, and there are some historic reasons for that. So if you're in one of the traditional community property states from Louisiana, Texas, Arizona, Nevada, Washington State, Idaho, you can get that automatically if the couple lives there. But Wisconsin, by its own statute, changed them from a non-community property jurisdiction for married couples to a community property jurisdiction. And the IRS ruled that even though they don't even call it community property, they call it marital property, it would constitute community property for federal tax purposes. And as a consequence, Bob and all his friends in it's the Badger State, right, Bob? Is that it?
Correct, Jonathan.
The Badger State get that income tax-free step-up in basis because under 1014B6, the surviving spouse's half of community property, and not just the decedent's half of community property, gets that tax-free step-up in basis, which is a very, very good deal. I was jealous of that, and I went up to Albany 6 times trying to get the New York legislature to allow New Yorkers to adopt community property by an elect-in method. But the male legislators knew I was only trying to help women, and they weren't going to stand for that, so they said no. But Alaska, which has a lot of ties to community property because it's so close to community property states like Washington and Idaho, went ahead and adopted a community property by an elect-in system. So if you have a client who lives in Alaska and you want community property, you can elect in. But even if you don't live in Alaska, you can create an Alaska community property trust and put assets in that and have the husband and wife declare it as community property under Alaska law. And then you should get the tax-free step-up in basis under section 1014B6. Now, there are 4 or 5 other states that have adopted kind of a quasi type of community property. Florida is one, South Dakota is one. I don't think they work. I'm not going to go into the details, but if you want to get a couple which does not live in a traditional community property state or Wisconsin, I think if you're going to do it, you ought to go to Alaska and create an Alaska community property trust, and you should get the income tax-free step-up in basis on both half of the property when the first spouse dies.
Let me ask you both a question. So now that we as practitioners, for the vast majority of clients under the current regime, and I get the permanent is only permanent till it's changed, but most practitioners have the vast majority of their clients off the estate tax radar. You've now given an explanation of a technique that's been around for a number of years and based on law that's been around for a long time, where we can go to our clients and say, listen, I know you're not worried about the estate tax, but don't forget me, your beloved estate planner. We can set up a community property trust and get you a full basis step up on the first spouse's death and eliminate all of the capital gain, no matter who dies first. That sounds like a winner. It sounds like a real value add. Thoughts, comments?
No, it is a value add. And so if you had somebody that was ill living in, let's say, New Jersey, they could bring, and they had property, they could bring it to an Alaska trust. It has to be a bona fide Alaska trust. Dot your I's, cross your T's. But if you elect into that community property statute, Marty, you're going to get a double step up in basis at the first death.
If you have clients where one spouse is not well, where you have clients where there's a significant age difference, it seems like a great planning opportunity. They have a very highly appreciated asset they'd like to sell, but the capital gains cost or the income tax consequences are just making it more difficult. Why not do this? Why not do this for real estate clients?
So
Well,
Jonathan,
if it's real estate, Marty, and the real estate is not in a community property state or in Alaska, I would suggest that what you want to do is to first put it in an LLC, because things relating to real estate are generally governed by the law of where the property is physically located. But if you want to say, hey, I'm from New Jersey and I have New Jersey real estate, but I want that double step up in basis under section 1014B6, what you ought to do is first put it into an LLC, so it's no longer New Jersey real estate, but it's an intangible.
I was actually assuming that it was an LLC as commercial property, but actually what you're pointing out is interesting. You can use the community property state for someone that has a house they bought in the Hamptons for 500 grand that's now worth $40 million, put it into an LLC and have it held by a community property trust and get the full basis step up on the first death, yes?
That's correct.
so can I ask a very practical question, Jonathan? I have an Illinois resident with Wisconsin farmland with virtually no basis, fair market value 15,000 an acre. If we leave things on their current course, there will not be a double step up in basis. But if we drop that into an Alaska community property trust, even though it's real property in another state, can we get a double step up in basis?
I believe you can, Bob, and I've been through audits, and agents sometimes complain, but that's the law.
Thank you.
So when you're thinking of basis planning, we talked about swapping assets out of trust. We talked about upstream, downstream planning. When we talked now about a community property trust. Jonathan, I'm going to ask you to comment about another topic, but I want you to keep it like to 2 minutes or less, okay? There's a concept that some have talked about called a joint estate step-up trust. Sorry, I clicked the slides wrong, forgive me. Just explain conceptually what it is, how it uses a GPOA to try to get a basis step up and your concerns about it. So this is another technique that some have suggested for basis planning, and I know you have some worries about it. Just succinctly give your concerns and thoughts.
Well, the theory is that you and your wife, Patty, Marty, would put assets in a joint trust. And because of the powers that you have on the part you put in and the part that Patty has over what she put in, it would be in the estate of the person who contributed to the trust. So if you put in, say, 30 million and Patty put in 10 million and you died, the 30 million would be in your estate because of your interest in that property. And you say, well, what about Patty's? And it's 10 million out of the 40 that's in there. But you will be given a general power of appointment over Patty's assets when she dies. So as a consequence, or when you die. So as a consequence, when you die. So the asset will be includable in your estate under section 2041. Now, the thought is that regardless of who dies first, the first spouse's estate will include all the assets, either because he or she contributed to the trust or because they have a general power of appointment. I have serious questions as to whether or not that works. The IRS has indicated that if you do have a transfer basically as of the moment of death, and it's going to go back to the other spouse because she or he has a general power of appointment over it, well, maybe you then have section 1014E apply, which denies the stepped up basis because it's an asset which has been re-inherited within a year of having made the gift of it. Remember, the gift won't be made, won't be complete until death, and it's going to instantly go back to the spouse because you have a general power. I don't think it works. And one of the people who has promoted this says, well, you could go to everybody in your neighborhood, find out who's going to die soon, and give each of them, as of the moment that you die, a general power. You'd be getting a general power of appointment, giving them a general power of appointment over assets that you put in the trust, so there'd be a tax-free step up in basis, even though they haven't exercised their general power of appointment. Now that means there would never be any capital gains tax at all, and I just don't think it will work. And I think it's pretty dangerous to try that and rely on it. I think you're much better off doing something like an Alaska Community Property Trust.
So this concept, some think it works. Jonathan has expressed and explained some of the strong concerns about it. Just let me make another point. I've talked to a number of practitioners around the country in non-community property states that use joint revocable trusts without even the GPOA and simply believe because of the joint trust, you get a full step up on the first death. There's no base. I don't understand any basis for arguing that. At least in the jest, there's an argument, although Jonathan has pointed out the concerns with it. So in our new quest for basis, just keep some of these thoughts in mind. Let's just take a second and talk about some of the existing irrevocable trusts. We talked earlier and introduced the program by talking about liability concerns that need to be thought about. You always have the swap power. You may be able to decant and add a GPOA. You may be able to add a limited power that could be converted to a GPOA. Jonathan's pointed out that you need to be in a jurisdiction where that won't create claims by creditors. Similar analysis applies to credit shelter trusts. I can tell you that, and I can't remember where I saw it. I think it was some IRS email and data, but there's something like 2 million bypass trusts out there. I don't remember where I saw the number. If that's even close, most of those trusts are probably very old and are going to provide no estate tax planning. And if nothing else, they should be evaluated because there may be sufficient distribution powers to distribute those assets to the surviving spouse. Make sure you evaluate the risks of lawsuits, claims, romance abuse, etc. But we may be able to simply terminate those trusts if there's an independent trustee with the power to distribute to the spouse, put the assets back in the estate and get a step up because the estate tax savings is no longer relevant. So it's certainly any accountant that prepares a 1041 for a bypass trust, raise the question, does this trust still make sense? Maybe we can get out of it. Bob, do you want to just mention, or Jonathan, just summarize a few last points on basis, and then we'll move on to the non-grantor trust?
Jonathan, go ahead, please.
Well, again, the focus today for almost everyone is to get the stepped up basis. And, you know, wealthy people have done a great job, but people think, well, gee, they've given a $15 million exemption and that solves the estate tax problem. But the real focus is we want that stepped up basis. If they had repealed the estate tax, you probably would not get the stepped up basis. That happened in 2010, where you could basically elect not to have assets in the gross estate, but then you had carryover basis. So by giving a big exemption with people no longer focusing on the repeal of the estate tax, but still having it in the estate, I'm aware of a number of people who were billionaires. They died, their spouse inherited their property, and there was no estate tax, but even though they had functionally a zero basis in their assets, it all got a tax-free step up in basis without any tax. And of course, now the surviving spouse has those assets, you can do more traditional estate planning. And that's going to be great. And you don't have to worry about the stepped up basis because you got it when the first spouse died. So that's critically important to think about.
So Bob, let's change gears for the rest of the program and talk about largely non-grantor trusts. I think you've introduced the concept, but I just want to re-emphasize because it's so fundamentally different. Most estate planners have spent most of their focus, and I'm not talking for the uber wealthy clients, but the vast majority of estate planners for the vast majority of clients have spent most of their focus on, you know, avoiding estate tax using non-reciprocal slats or gifting, and using revocable trusts and other mechanisms to avoid probate. But we now are adding to that using non-grantor trusts for income tax planning. So for many estate planners, this is a big pivot. They're going to want to hug all their favorite accountants because now the focus of much of estate or trust planning is going to be saving income taxes, not avoiding probate or saving estate tax. So for a lot of people, it's going to be a big pivot. Any general comments? If not, we're going to just jump in and talk about SALT on slide 40.
No. Complete renaissance in non-grantor trusts. Here's my thesis. For the moment, we have a $30 million estate tax exemption. That means one out of about 400 families will have an estate tax problem. And that means that the lawyers that spend every day helping these families will have less estate tax planning to do, and they will pivot to doing income tax planning using trusts. So Marty, that could be non-grantor trust for the things we've been talking about, SALT, etc. It could be more charitable lead annuity trusts. It could be more charitable remainder trusts, but it will be income tax planning that has its genesis in the trust code, meaning we're going to use a trust to accomplish an income tax objective. And I think that will be the really big thing in legal education and for accountants in the next 24 months.
So why don't you go through the example? You had mentioned how we can use a non-grantor trust to save SALT, and explain it clearly so people not familiar with it understand it, because the same concepts apply to lots of other tax benefits.
Sure. Here's what's going on conceptually. With SALT, when my wife and I get a $40,000 SALT deduction. However, that goes back to 10 if our income is at 600,000. So Marty, if you and Patty have 600 of income, you're only going to get a 10,000 SALT deduction. But if you can move 100,000 of income off your return into a trust, you now get your SALT deduction back. So that saves you about $12,000 or $13,000 a year. Now let's just go through that a little bit further. The next thing we have to do is, can that trust also shift income potentially to my children? But let's look at the example. So client's income exceeds 500,000, this $40,000 SALT deduction is going to be lost when you hit 600,000. If you can bring your income back to 500,000, you get your SALT deduction back. So
of course, this is only if you itemize events.
This is only if you itemize. But the easiest thing to do is if you're right at that, between that $500,000 and $600,000 range, how do I get some income off my return, Jonathan? How do I get income onto a trust return or onto my children's return? And because if you're in that 500 to 600,000 range, Marty, the effective federal tax rate is 45.5%. Well documented, nobody disputes that calculation. So this is a big thing. So what my lawyer could do would be to set up a non-grantor trust. I shift my property into that non-grantor trust, and suddenly I get my SALT deduction back.
Big income tax savings potential. And
Now,
for those
you'll be using gift tax exemption to do that, but that probably is well worthwhile.
But Jonathan, we might not have to use gift tax exemption. We could create this, other than in New York or California, we might be able to use the ING format and have it be an incomplete gift.
That is true, Bob.
On slide 41, Jonathan, you had raised the question of how you get a trust to have an adverse party approval. Let me step back and explain what we're talking about, why, and how this fits into planning. So first, this kind of planning can work for a mass affluent client. You don't need somebody worth 20, 30, 40 million dollars. This can work for somebody worth $5 million or $4 million or $3 million, because they may still be able to get a good current income tax benefit by shifting, as Bob explained, assets that generate passive income to a trust and getting it off their personal Form 1040, their personal income tax return. Now they get the SALT deduction, and we're going to talk about other deductions, because you can compound or multiply the different deductions that this planning can benefit. But for a client that's a mass affluent client, $2 to $10 million, for example, they're not going to likely be very comfortable, and let's assume a married couple to keep it simple, they're not going to be comfortable giving up any access to these investment assets they move off their balance sheet. And obviously it's not retirement assets, it's savings that are non-qualified. So a common type of trust tool to use, which everyone's familiar with, is a spousal lifetime access trust, or a SLAT. But a SLAT, it serves the purpose that the spouse is a beneficiary, so the settlor spouse can benefit indirectly through the spouse as a beneficiary. But that won't accomplish the goal, because if my spouse is a beneficiary, it's automatically going to be characterized as a grantor trust income tax to me, I've not been able to accomplish what Bob said. But I can set up a spousal lifetime access non-grantor trust. Ed Morrow likes to call them slants. Jonathan and I had coined the term salty slat for the SALT deduction. Whatever you want to call it, you can set up a non-grantor spousal lifetime access trust. The advantage of this concept for a mass affluent client is that they can save current income tax. Their spouse is a beneficiary, so they can continue to get access. So you got income tax savings and access. It's not the slats in the traditional typical application to save estate tax exemption, although it's in the completed gift format, it will do that too. Now, the one nuance, or one very important nuance, and there's many, in order for it to be a non-grantor trust and still get access, you can't have the swap power. You cannot have the power to loan to the settlor without adequate security. But if my spouse is going to get access, a distribution, it has to be approved by an adverse party. Who's an adverse party? One of our kids. Why? Because if the kid approves a distribution to my wife, the kid have less in the trust they can, so it's adverse to them. So with the adverse approval, and I suggest you consider actually documenting that, not just having the provision in the trust, but if a distribution is going to be made, have a sign off by an adverse, document it in the trust records before distribution's actually made, so you can prove adherence to it. Now can give a client a current income tax savings, like on SALT, we're going to have Bob explain more of them, and still preserve access. And gee golly, Jonathan had mentioned many times about potential changes of the future of tax law, estate tax rules. Let's say in 5 or 10 years, all rule change in this trust no longer serves purpose. An independent trustee can distribute the spouse and really unravel the plan. You probably need not care exemption used, but you adapt. The point is it's flexible. So we can give a client current income tax savings, flexibility to access, flexibility to unravel the plan later.
I mean, Marty, you're breaking up a little bit. I don't know whether it's your head. Bob, am I correct that Marty is breaking up?
No, I can take this next slide and we'll give Marty
Sure.
a chance to try to fix that. So basically, we talk, SALT's easy to understand. QBI is a little harder to understand. And what happens with QBI is once my income's too high, I can lose my QBI deduction. So there is a phase out range under OBBBA. Now it used to be $100,000 phase out. Now it's gone to 150. But the interesting thing is, let's look at an example. So you have a dentist earning $200,000 a year, and she sets up 3 non-grantor trusts, 1 for each child. Can she gift the building into the trust and shift that income off her return? The answer is absolutely yes. She can gift the building. Now, she couldn't gift shares in her dental practice, probably, because that would probably be an assignment of income under Lucas versus Earl. But she certainly could gift away the real estate, gift away both the fruit and the tree. The practice then leases the use of the building for $50,000 a year. We get that income off her return, and we pick up a QBI deduction either at the child's level or at the trust level. So a lot of good things can happen. So I think we have to be conscious of how to use non-grantor trust to enhance the QBI deduction. Marty, let's go up to the next slide, please.
By the way, this is also great asset protection planning. If you have any kind of physician or other professional that has a building in their practice, why on earth expose that valuable non-practice asset to the suits and claimants of the practice?
So Marty, the same thing to a lesser extent could occur if somebody there's all these phase outs under OBBBA. One of those phase outs is tip income. So maybe if you had too much money, too much income, you wouldn't be able to exclude your tip income. Can you get your income down? If part of that was, basically interest or dividends, can you get that off your return? And so this could be a very common thing. I certainly know there's people in major cities that work at wonderful restaurants that earn quite a good income and their tips won't be taxable up to $25,000.
Yeah, the point is that any OBBA tax benefit that's subject to phase outs, a non-grantor trust may work. And the whole point is this works for clients that are far less high earners and far less wealthy than a lot of the traditional clients estate planners have served. But we can bring value to these people in terms of asset protection planning and income tax planning, even if the estate tax is irrelevant.
Absolutely true. And then the other thing, Marty, is we can also do the same thing with QSBS, the qualified small business stock.
That's big.
And that's big. So people have come to see me. Let's say that somebody comes to see me tomorrow. They're about to sell their C corporation for $50 million. They could exclude 10. 40 would be taxed. But if they transferred $28 million, theirs and their wife's exemption, to trusts for their children, 3 separate trusts, they could exclude that entire 28 plus the 10. Now, if they go further and they use a NING, they could even transfer more property.
Bob, what about someone who doesn't have a C Corp but has an S Corp or a partnership?
Well, if they have an S Corp, they won't qualify for QSBS absent further planning and 5 years after that point. But what you can do is I can still get some of that income off my return. If you had somebody selling their business for $1 million, Jonathan, they could potentially spread that out across their children and reduce that rate. So maybe instead of being at a 23.8% rate, they could drop that rate down to 15%.
Bob, a lot of estate planning attorneys are really not familiar with the income taxation of non-grantor trusts. We don't have a lot of time, but and I'll advance the slides as you tell me, or you can just ignore them and talk about it. But can you just give a quick overview so estate planning attorneys that are not versed in non-grantor trust income taxation just understand some of the basics? Because that's important for all the stuff that we've just talked about.
So when you have, let me juxtapose this with a couple things. When you have a C Corp, all the income is taxed inside the C Corp. And when you have a partnership or S corporation, all the income is taxed on the return of the owners. When you have a trust, the income is taxable to the trust, but if you sprinkle that income out to the beneficiaries pick that up on their return. So it's a quasi flow-through entity. So if a trust earned $100 and it paid out $70 to the beneficiaries would pay tax on $70 and the trust would pay tax on $30. So you can shift the income from the trust to the beneficiaries. And that's the strategy. And it's a very small, it's certainly less than, if you really wanted to understand trust taxation at a pretty competent level, it's probably only 40 or 50 hours of work. So if you're willing to devote an hour or two a week for the next 20, 30 weeks, you'll be fine. You'll figure this out pretty quickly. So Marty, it's about do I want the income on the parents' return? Do I want a trust return? Or do I want to get it out to children and grandchildren? So the mechanism is all through subchapter J of the code, section 661 through 663 give us this concept of D&I, distributable net income. And non-grantor trust can deduct distributions to beneficiaries through the D&I mechanism. And then the beneficiaries have to pick that up on their personal return. Now, part of the reason we do this is because the trusts are in a compressed tax rate, 37%. So if my children and grandchildren are all in the 12 or 15% rate, but the trust is at 37, no doubt we want to move the income off the trust return to children and grandchildren. Now, the dynamics of this, when you have a bypass trust, are interesting because if I distribute it back to my wife, Marty, I'm just going to throw it into her taxable estate. But if I distribute it to my children or grandchildren, I'm pushing it further downstream. So that's kind of what's going on here.
But the difference now is the spouse, the surviving spouse, may not be subject to an estate tax. The key point is people often dismiss trusts as really inefficient from an income tax perspective. We've demonstrated that trusts can gain significant income tax advantage on the settlor side, the client setting it up, because you now may qualify for a SALT deduction, a 199A deduction, amplify and expand the QSBS deduction, and other OBBBA tax benefits. Now, on the second side, on the trust side, you can sprinkle income out if you have beneficiaries and get the brackets lower, avoid the NIT tax, avoid the highest income tax, so you can get benefits on both sides. You can bookend your tax benefits. If we had an extra half an hour, I'd have Jonathan explain his concepts of flexible beneficiaries that can enhance that even more. But I think people, when they say, oh, geez, trusts are at a high tax bracket, compressed tax rates, it's true, but it's only part of the story. You can get tax benefits on both ends of the equation. And that's really a powerful planning tool that estate planners need to add to their repertoire, their toolkit. Bob, just explain quickly on 48 state income tax planning with trusts. I know you've kind of mentioned very quickly California and New York, but in general, what we can do with non-grantor trusts.
Sure. Say someone lives in California or New York, okay? We'll just take those two. They move property in a completed gift to a Alaska or Nevada trust. That income is outside of the taxing jurisdiction of New York or California, provided it's not source income to that state. Let me give you an example, Marty. I move a $5 million portfolio that earns interest and dividends, all publicly traded securities. The state of New York and the state of California have lost their ability to tax that income. However, if I moved California real estate into a Nevada or Alaska trust, I've accomplished almost nothing, because that's called source income. So if it's from real property, it's going to be harder to get out of your state. Now, what you do with real property is you set up debt. If you had a building that was paid for, maybe you leverage that up, and then you invest in other property, and you move that other property along with the debt, and you bring out source income. You reduce your California source income. But basically, a trust could also loan to beneficiaries. We can make unequal distributions. This is especially powerful when parents live the senior generation lives in a high tax state and children in a different state, because now I can get income to those children where they'll pay no state income tax.
Jonathan, I know we're running out of time, but it's a clever idea. Can you just very quickly explain this concept of giving a 678 power to someone to pull out the state side of state source income? We did an article for Lissy some years ago on a peppercorn of income. And the concern is that somebody that has a portfolio, they may have a partnership interest that has a dollar of state source income. How do we address that? What's that?
Well, New York and California basically take the position that if you have a trust, which is a non-grantor trust, the trust is still going to be subject, if it's been created by a New Yorker or a Californian, to full California or New York income tax if you even have a dollar of source income from that state. So a New Yorker creates a trust, it's not a grantor trust. They puts in, or she puts in, assets, and there's a dollar of income that's imputed to that trust, which is New York source income. Well, that means that New York takes the position that all the income in the trust is now subject to tax.
For $1, all of it's taxed.
All of it, and not just the $100 or $1 of New York source income, but the $500,000 or $1 million of income. New York now claims, California would do the same if it's California source income of a trust created by a Californian, is subject to complete income taxation in that state. So to avoid that, what you do is you give a beneficiary right in the trust the right to withdraw all of the source income. If you created a New York trust, you give the beneficiary, who's not a New Yorker, but you could even do it if he or she is a New Yorker, the right to withdraw all of the New York source income. That means that that income is now going to be attributed under Section 678 directly to that beneficiary who has the right to take out that source income. It will no longer be income of the trust, and the trust will no longer be subject on all of its income to New York income tax. Very good thing to do. So when you're dealing with clients and they may have, they're from a state, New York, California, or another state, New Jersey, and you say, well, I don't, I can't be positive I'm not going to have at least $1 worth of source income. Because again, if you're invested in a partnership, part of that income may be source income. So you want to put that in all of your documents, that to the extent that there's any source income attributable to a state that would impose an income tax, you're giving the beneficiary the right to withdraw all that income. And under Section 78, that would be then attributed to the beneficiary. It's not income to the trust, so you shouldn't have to worry about it at all.
This is a very clever concept that's not used nearly enough. And when you're using non-grantor trust planning, both to qualify for post-OBBBA tax benefits, as Bob explained, to use flexible beneficiaries and save income tax for the family group overall, the peppercorn concept of a 678 power that Jonathan just explained is another fascinating and creative add-on that's not done enough. And hopefully what we've just done in this discussion is given you an understanding of how post-OBBBA you can provide incredible value to a very wide swath of clients from an income tax planning perspective using trusts in creative ways. It's not just about estate tax. It's not just about asset protection. It's not just about avoiding probate. It's about income tax planning. And that's a huge pivot. I think we're kind of running out of time. Let me just make a comment on slide 51 and 52, and I mentioned I'd plug ILS a few times. This is another important point. You got to be very careful taking some form that you have in your office and thinking you're tweaking it to make it a non-grantor trust to do all the planning we talked about. There are a range of different powers that can trigger grantor trust characterization. So a non-grantor trust has to be a very carefully crafted document. In the ILS language, they have, and in the template, and I'm sure all the drafting software, document generation software products have non-grantor trust. I don't think you want to start where you have a choice with a document for a grantor trust and mark it up. Start with a non-grantor trust. The last two pages here that I just went through, 51 and 52, I think, are the sample ILS savings language. In simplistic terms, it says, hey, if I accidentally somehow inadvertently put in a grantor trust power in the trust that could include, but is not limited to all these things I just listed here, they don't apply. You may also want to have savings language in your non-grantor trust to make sure you actually achieve that goal. And by the way, and we're not going to get into it today, it's another interesting topic that we should probably do a whole program on. If you want to convert a grantor trust to a non-grantor trust, you have to address all of these powers and probably want to include savings language. We have, but we're going to skip it because we've done it in other programs, a number of slides on charitable planning. The one piece that I wanted to focus on, but we're gonna skip it because we've kind of done it, is that when you want to get a charitable contribution deduction, for many people it may pay to move it off of your personal Form 1040. You put X dollars into a trust that of assets that generate the income that you want to go to charity. So the client can get the 31.5 if they're married, filing joint, standard deduction. They can move 300 grand off to a non-grantor trust. If they get 5%, that's 15 grand. The 15 grand can go to charity. The trust can offset it almost dollar for dollar. I'm going to let Jonathan very briefly explain the 237th issue. But the idea is that for lots of clients, a large swath of clients that may not be at the wealth level where they want a sophisticated, non-reciprocal SLAP plan to save estate tax, they can benefit by shifting as just exactly as Bob explained for SALT and 199A and QSBS. They can shift income, passive income off their personal return to a trust, let the trust make the donation. The trust gets an almost dollar for dollar offset. So they've now, in effect, removed income from their personal return, giving the same level of charitable contributions and saved significant income tax year after year. That can be structured as the spousal lifetime access non-grantor trust, so they still have access. Independent trustee can later distribute assets to spouse to unravel the plan. In a charitable trust application, and you can use the same trust for charity and SALT and other benefits all in one, and put in the peppercorn concept too if you're trying to save state income tax. In the charitable context, you got to be sure that they're cognizant, the trustee, of 642C. They can't ACAT an appreciated stock to the charity. They have to realize income and donate the realized income. And also you need to include the charity in the governing instrument to meet the governing instrument requirement. Jonathan, just briefly explain the 237th haircut and what that may mean.
Well, this is a complicated matter, and we could spend at least an hour, if not more, on it. Basically, what has happened under the new act, which will take effect at the beginning of this coming year, you basically have almost all of your itemized deductions cut back by the difference between the tax rate at the top rate and the rate below it. So what they did is they say, we're going to take away the benefit of an itemized deductions by 2/37. And that will mean that you don't get the full benefit of your charitable deduction or your other deductions that you otherwise would get. And for an estate or trust, which is supposed to have an unlimited deduction for its gross income paid pursuant to the terms of the governing instrument to charity, that will no longer be the case. So right at the beginning, you're going to go ahead with an estate or a trust. Once you're over about 16,000 of income, that 2/37 kicks in, and it will mean that you don't get the full deduction for the amount you've given to charity. It's very important. And if you have a trust or an estate where it's going to be a non-grantor trust and you were counting on everything going to charity, it will not, you will wind up paying income tax. So, you have a wealthy guy like Bob Keebler who's going to leave his $500 million estate to a charitable foundation, and he says, well, once I die, there'll be no income tax paid. We'll get pay income tax, because once you're above, for a trust, about 16,000 of income, that 2/37 cutback, it's about 5.5% of your itemized deductions for charitable or other itemized deduction will be taken away. So even if you have an estate where it's going 100% to charity, 100%, you're still going to have to pay income tax on it. And that's really something that I'm not sure was well thought out. And some believe it was a mistake in drafting, and it doesn't really mean that. And you can still get the benefit of the full deduction without that 2/37 cutback. About 5.5% would be disallowed.
Jonathan has not told you about something very exciting. If you can't sleep at night because you're so focused on what Jonathan just explained, we have a separate webinar just on charitable planning post-OBBBA where we spend, I think, 60 minutes or 90 minutes talking just about the charitable planning that I covered in like 3 minutes. And we have a whole 60-minute program on 68E and the 2/37 cutback. So if you can't sleep at night because Jonathan's gotten you so excited with his explanation, quick explanation of 2/37 cutback, we have at least 2 hours, if not more, of programs just on that. You can get them on the Peak and ILS website, and the Shenkman education site is a new site I'm launching where I'm putting all my educational materials. That should be up shortly. So there's hours of more material on that if you just can't sleep at night thinking about it. Let's just wrap up because I think we've covered a lot. Bob, why don't you give a wrap up, and if Jonathan or I have anything to add, we will.
I think we start with existing trusts that have already been funded, and the lawyer and accountant should probably have a quick call on each of these trusts, and just the accountant should probably get the lawyers the last couple of years of tax returns, walk them through it, and then just see what ideas come out of that collaboration. And then basically for new planning, look at people that are going to have a problem with SALT or QBI or QSBS. Can we do anything with a non-grantor trust to make that better? Then we have to have an emphasis, Marty, on charitable giving. And I just met with somebody who always runs into the limitation on charitable giving. And I said to him, has anybody ever explained to you a charitable lead annuity trust? He said, no. I sent him some things out of my book to read. And sure enough, now he wants to do a charitable lead annuity trust. And he has enough basis in those securities that when we sell those securities, we should be able to overcome this 237th limitation. And now the one thing on 237 though is, this is complicated, but Marty, we have to be even more cautious not to use shark fin clats if we're seeking an income tax advantage, because you'll always end up with not enough income distributed in the first year and a ton of income distributed in the last year where you won't have enough charitable distribution. So, enough income. So I think there's just so much opportunity, and I would really encourage both the accountants and the estate and trust lawyers to just wrap your mind around these possibilities, because you're going to help a lot of people.
You know, we're living in an environment where more and more clients are just asking AI, what do I do? There's just no way that today, I'm not saying tomorrow, but today, that AI can really address the array of different things that we've talked about. Clients are, even some wealthy clients are trying to get stuff done inexpensively, whether it's online or by pressuring an attorney for a flat, cheap, fixed fee. This kind of planning that we're talking about can be a huge value add. And as AI and document generation software lessen the value of some of the traditional documents that may have been provided, there's a huge amount of planning that we can provide that can provide a value add. And it's not just for the clients subject to estate tax. We've demonstrated, I think, very clearly how you can get down to clients with much more modest income and wealth and provide valuable services. I think one of the most important messages, and we've talked a lot about it, is flexibility. Nobody has any idea what's going on. When I look back at the webinars that Jonathan, Bob, and I have done, since 2020, it's been a veritable roller coaster of potential changes. Some have gone through, a lot of them haven't, and that's going to continue. So whatever planning we do, think of the back end, think of access, think of ways to give flexibility with trust protectors, decanting provisions, flexible beneficiaries. And Jonathan and I have done a webinar on that. It should be on the Peak and ILS and my website as well. There's lots of ways to infuse flexibility into this planning. Don't overlook that. Jonathan, you get the last word.
Well, Marty, all I can say is you're right. Don't worry if you're an estate planner that your practice has been hurt because you no longer have clients who all fall under the $15 million threshold. There's so much you can do for them. It's just extraordinary. In fact, I think if you study these, and that's what it takes, you have to know these like the back of your hand, your practice can just flourish like crazy.
Thank you, everyone, for joining us, and thank you, Jonathan and Bob, for your input. And we wish everyone good luck with post-OBBBA planning, and I'm sure we will find other topics to do to keep the momentum going as we all collectively as colleagues try to figure out what we can do now in this new environment. Thank you.